Alrighty, guys, as promised, here we go with the second um, part of this chapter 1. Okay, so remember we got going concerning the fundamental uh, equation, assets equal liability plus owner's equity. So we're going to continue with that and understanding that. So we're looking now at the balance sheet. Remember how I told you that everything has to balance out, and we looked at those transactions, how everything tends to balance out, and everything has to, whatever's on one side of the equation, it has to be on the other side of the equation, just like in college algebra, except a little different, okay? So the balance sheet, one of the first reports that is done, making sure that everything is correct, shows the history of the company as far as the transactions that have been recorded, the financial position, meaning are we ready to go ahead and did we make a profit? Did we lose money? What ended up happening? And of course, it goes ahead and presents the ending balances of the assets, liabilities, and the owner's equity. Assets appear on the left side and the liabilities and equity on the right side, okay? Of course, may seem different on the video, but don't worry about it, okay? So this is what we have. So for example, here's are your assets, okay? So you have your assets and you have your cash. You have your cash, remember what we did before, where you have the cash and the explanation of what ended up happening. If I leave it there long enough, you'll see of the cash that was for the $5,500 at the end, the office equipment that we had brought up. Remember, she purchased some on capital as well, so she's got an accounts payable. And this is the $300 for the accounts payable. So you have your liabilities that are there. And then the total amount of money that she brought in on her own, which is again, showing you the 55 plus the 1,000 equals the $300 of the accounts payable plus the capital that's coming in. So everything then, again, balances out, which is great, according to the fundamental accounting equation, okay? So preparing it, though, of course, you're going to have the company's name, the name of the statement, the date, which is reported, which is usually at the end of the month, and, of course, the dollar sign on each of the columns top figure to indicate the fact that this is money that we're dealing with, not just random numbers. This is money. So this is what we're going to be doing. So now as we start looking at everything, we start looking at the expansion of the accounting equation, which includes the money that you made, which is revenue. It increases the owner's equity. It's recorded when it's earned in the month and in the day. And then the decrease of any money that's taken out as far as withdrawals, such as the owner decides to go ahead and take money out because he has a right to, because remember, he invested money in or she invested money in. And then, of course, also your assets as far as increase. Now, let me go back. The decrease of owner's equity because he's taking money out of the company, okay? The assets as far as any cash accounts, any money that has been brought in, or any of the office equipment that you have, and not just or, but and accounts receivable. Now that's when you become the person that other people owe as far as the company, that people owe you money for the services rendered or the products that they purchased, okay? Expenses. Expenses are anything that you have to pay, rent, utilities, wages, miscellaneous office equipment, the consumables, paper, pens, pencils, paper clips, things like that. Let's say that you were in a restaurant, anything of the things that you have to purchase, which would be the expenses of the foods for preparation, you know, all of those items, any inventory that you had to purchase, all of that is considered an expense, okay? Taking money out to make money in the future, hopefully. And they're either they're recorded when they're incurred or when they occur, and paid in cash or a promise to pay in the future. accounts payable. Okay, so here we go. Revenues minus expenses equals revenues minus expenses equals either a net income or a net loss. And the reason why it's stated this way is because if you make more money than your expenses, then you've made a net income. However, if the revenues are less than the expenses are higher, then you have a net loss. Okay? If revenues are greater than expenses, then net income increases equity, meaning I've made more money, I've made money. If expenses are greater than revenues and it equals a loss, then it decreases the amount of money or the equity that the owner has in the company because the company doesn't have the same money. Let's say that you lost $1,000. So, and you've, let's say Mia Wong, she has, according to the transaction, still $6,500. But let's say the following month she has $1,000 loss. Then she now just has $5,500. So she cannot say, I'm going to take out $6,500 as my equity because you lost it. You can't. So see how it decreases the equity that she has in there? I know, it sounds weird, but we'll see it in the transactions, okay? Withdrawals, of course, that's when they may, an owner can go ahead and take money from the company to pay for personal expenses. This is where some business owners get into trouble. Too many times they're taking money out instead of reinvesting it into the company, and it decreases the amount of equity that they have because they've been paying themselves off. It's not related to the business in any sense, and it's not an expense either. It cannot be considered an expense. It's a withdrawal, okay? So here we go. So again, beginning capital plus additional investment or a capital, either cash or equipment, plus revenues minus expenses, and of course withdrawals. If expenses are greater than revenue, then there's a loss, and again, this will be taken out. So here we go. We have an expanded equation here. So here we have the cash that we had for $5,500 still from Mia Wong. Okay, she went ahead, they had the $5,500, but notice you have $2,000 of cash. So now this goes ahead and brings in up the cash to $7,500. She still has the same amount in the office equipment, the same amount in the accounts payable, her initial investment. But notice, wow, revenue. She provide legal services for $2,000 cash. Again, learning the verbiage. So she made some money, she made some revenue. So that increases. So the $2,000 is added here, plus the $1,000 in office equipment is $8,500. So here we have the $300, the $6,200 still in capital or equity, plus the revenue, same. Notice how voila, it actually goes ahead and balances out. Okay? Another one. Here we have provided legal services on account. All right, on account, meaning that they owe her because she provided the services. So now you have cash, accounts receivable. It is an asset because it can be made into cash quickly, or it's something that's made into into cash, like I said, but it's quickly made a liquid amount, meaning cash. So here we have the $3,000, but again, she doesn't get all of it. We still put in the $3,000, but they're going to pay her on it, okay? So here we go. We add the $3,000, and we end up having the $11,000 now, and accounts payable, and then we put in here the revenue, okay? Even though it's still not entirely received, you still put it down as being revenue for that month because you still made some money. Even though you're making money in the future, you have to record when you made the money, okay? Now we're looking at receive $900 cash as a partial payment from the previous services performed. Previous was the $3,000. Okay, so now this is what you do. You take out the $900 from the accounts receivable. You were paid that money, so you put it into cash. Nothing happens on this other side. It's not considered revenue because it was previously recorded as revenue. It's now taken or deducted from the accounts receivable, meaning now they don't owe you $3,000 anymore. They only owe you $2,100. See how we're recording everything into detail. So again, $8,400 that we got in. Accounts receivable is now only $2,100. Equipment stayed the same. Accounts payable, you haven't paid any money on that yet. Your equity stays the same. Revenue stays the same for the month. You haven't made any more. That goes ahead and balances out to $11,500. Okay? Then now we have salaries. That's an expense. Salaries is always considered an expense because you're paying somebody for working for you. So notice how that is an expense. And now you see the expanded statement showing your wages expense. So you paid $700. You're taking it out of cash. So now you're only left with $7,700. Accounts receivable stays the same. Office equipment stays the same. Accounts payable stays the same. Capital doesn't change. Revenue again doesn't change. Expenses then is now added to where you now have the, and understand this, the expenses is added to the expenses account. Okay? But we'll get into the normal balances, but it's added to the account, but it's taken out of cash. Okay? I was going to say something, that's why I paused, but I'll get into that a little bit later. Again, rent expense, as I stated before, taken out of cash, added to your expenses, so that now you have recorded that you have $1,100 worth of expenses for that month, paid between September 1 through the 30th in there. Okay, so here you go. And of course, you decrease it from your cash. So now you've balanced out to $10,400. Everything stays the same except for the cash and the expense account. Now you have an advertising expense, another one. Okay, you're adding that advertising expense. Okay, but notice what it says: to be paid next month, not now. So you add it to the expense. So now you have $1,300 of expenses, but you add it to your accounts payable because you're not paying it yet. It's not coming out of cash. So you add it to your accounts payable account so that you're adding there. Now you're showing that you owe $500. But now you have the $10,400. Both, nothing happens to accounts receivable, nothing happens to office equipment, only accounts payable and expenses. Okay? Now, here you see where Mia is withdrawing $100 for personal use. So she is in a sense paying herself from the revenue. But notice, it's not considered an expense. It's a withdrawal. So everything remains the same except for the cash account where she takes money out, and now you have it in your accounts, on your account under withdrawal, so that you're recording how much money she's withdrawn. Okay? So now you have only $10,000 as far as the balance of everything that's occurred at this present time. So this is the expanded accounting equation. This is something that you're going to see in your homework, okay? Where you did your first transaction, the first one where she started up the business, okay? Of $6,000 in cash, $2,000 in equipment, and the $6,200 for the amount that she's got total, okay? Then where she went ahead and she took $500 out of cash and purchased the office equipment, giving her the $5,500. So all the transactions that we've done at the beginning, notice when we went through this, notice how we have your total here of $7,200, your amount of $2,100, your office equipment is still of $1,000. And notice how you're bringing down the balance for each month. And let me just let you know now, if there is no transactions in that account, you typically want to put in a 0. The only reason is because when you're using the spreadsheet, your recording of a 0 then helps you to keep recording things on the correct time and day. All right. So notice how everything balances out to what we just stated, the $10,300. Okay. That's now using the expanded equation we're using of the liabilities of assets equal liabilities plus owner's equity, expanding it to include revenue and expenses and a withdrawal. Okay, so this is 2. Now we're going to go into part 3, and then I'm also going to have not a chapter summary, but a demonstration video on a similar homework assignment problem. Okay? See you on the flip side.